Welcome to our comprehensive tutorial on long-term capital management, or LTCM. In this video, we will explore the rise and fall of LTCM, a hedge fund known for its use of complex mathematical models to exploit market inefficiencies. Long-term capital management was founded in 1994 by John Meriwether, a former vice chairman and head of bond trading at Salomon Brothers. The fund was renowned for its team, which included Nobel laureates Myron Scholes and Robert Merton. LTCM aimed to leverage their expertise in finance and quantitative analysis to generate high returns. LTCM's strategy involved taking advantage of market inefficiencies through arbitrage. Arbitrage is the simultaneous purchase and sale of an asset to profit from a difference in the price. It is a trade that profits by exploiting price discrepancies of identical or similar financial instruments on different markets or in different forms. Let's consider a simple example of arbitrage. Suppose a stock is trading at $100 on the New York Stock Exchange, NYSE, and at $101 on the London Stock Exchange, LSE. An arbitrager would buy the stock at $100 on NYSE and sell it at $101 on LSE, making a $1 profit per share. In its first few years, LTCM was spectacularly successful. From 1994 to 1998, LTCM reportedly generated annualized returns of over 40%, well above the average market returns during that period. However, these high returns came at a cost. LTCM strategies were highly leveraged, meaning they borrowed large sums of money to increase their investment positions. Leverage amplifies both profits and losses, making the strategy highly risky. By 1998, LTCM had borrowed over $125 billion against an equity base of about $5 billion, creating a leverage ratio of 25-1. This meant that for every $1 of LTCM's own money, they had borrowed $24. In 1998, several events led to the downfall of LTCM. These included the Russian financial crisis and subsequent default on government debt. These events caused unprecedented moves in financial markets that were not accounted for in LTCM's models. LTCM held a large number of positions betting on the convergence of market prices. However, the Russian default caused a flight to quality, with investors selling risky assets and buying safe ones. This caused the spreads to widen instead of converge, leading to massive losses for LTCM. By the end of August 1998, LTCM had lost $4.6 billion in less than 4 months. With its highly leveraged positions, the losses were too large to manage, and the fund was on the verge of collapse. Faced with the potential collapse of LTCM, which could have triggered a systemic crisis in the financial markets, the Federal Reserve stepped in to orchestrate a bailout. A consortium of 14 banks and brokerage firms injected $3.625 billion to recapitalize the fund. This intervention prevented a worse financial crisis but raised questions about moral hazard. Moral hazard occurs when an entity has an incentive to take excessive risks because it does not bear the full consequences of those risks. After the bailout, LTCM was liquidated in an orderly manner, and by early 2000, the positions were closed. The episode of LTCM highlights the dangers of excessive leverage and the limitations of quantitative models in predicting market behavior. In summary, while LTCM initially achieved phenomenal success by leveraging advanced quantitative strategies and high leverage, it ultimately failed due to significant market events that its models did not predict. The lessons from LTCM underscore the importance of risk management and the dangers of excessive leverage.